Good morning, everybody. This is Patrick MontesDeOca once again here with a live trading room at the Equity Management Academy. This segment is brought to you by the Equity Management Academy. To go right into today's segment, what I would like to do here is to review the report that we published over the weekend. Called the VC Weekly Price Momentum Indicator. And I want to take a look at particularly the price of silver as we begin this week. And I think this week in particular, it's going to be pretty volatile as the FOMC meeting takes place tomorrow, Wednesday. And basically they are going to speculate on what they should do with regards to interest rates, whether they're going to raise interest rates or lower interest rates, or, you know, in my opinion, I think it's simply what I call chatter. And to reduce that chatter, I use this codes, this methodology, these components that you see here, the color, they all have a relation to basically identifying very specific criteria for us. In blue, it's demand. When we look at the price in blue, we basically are looking at where the demand seems to be accumulating. As you can see here, once we went through that resistance, which was demand before the market, before the price, before it becomes support to the price, it has to go through it and above it, which it did here on July the 1st, very decisively. This bar here was a tremendous reversal of energy and a follow through from the previous bars. It was an acceleration that we were anticipating. And now the market has identified where the supply is, basically, and we seem to be trading on just under the July 5th high when Brexit took place, and we haven't been able to challenge those highs as of yet of 21.22. But we clearly see here that the price got to the extreme above the mean, and the mean or the average price or the pivot point, these are all pivot points, every one of them. The 9-day moving average that we use on the report, which we'll take a look at it in a few minutes, but these are very specific levels and pivot points that indicate for us certain criteria. When the price comes down to blue, it tells us you're in the demand zone. When the price activates the signal from this zone, then we trade from the long side. And simply because the energy, if the energy is greater, which happened here just a little while ago here on the early part of this month, if the energy of demand from the blue zone is greater than the selling pressure from the resistance or supply area, okay, the price will have to go up, obviously, just the other way around. So where, you know, what you see here is that we have established some kind of an average price of about 19.20-25 in the silver market. 1917 is the algorithm for today. Excuse me. And what we're doing is we are trading, reverting to the extreme above the mean, which in this case is the red zone or the supply zone, which is what the algorithm identifies for us. And it tells us that we have supply to challenge at 1950 and 1971. Now, if the demand energy or the buy-in energy is greater than the selling pressure, then the price closing above 1971 would essentially convert this level of resistance into support. Every time the price action, the only constant thing here is the price action and movement in relation to these codes that we produce daily, weekly, and monthly. The methodology is the same. This is the daily numbers that we're looking at for the silver market. Now, if we bring in the weekly report that was published on Saturday, we're going to be taking a look at the weekly signals now for the silver market. And I want to focus primarily on the silver market here, which is the chart on your left, because the market in silver seems to be telling us a different story than the gold market. And if we take a look at silver here for a minute, as we came into this week, the market closing on Friday at 1886, excuse me, it was below the 9-day moving average that we use to identify the trend momentum. This is a separate indicator that identifies for us the trend momentum, and it's the 9-day moving average, and it's on 1953. So with the market closing below the 9-day moving average, it's bearish. The sentiment is bearish. The trend momentum is bearish. The sentiment is bearish. So we have a good idea what the sentiment is like. But at the same time, this is a pivot point that if we do close above 1953, it will negate this bearish sentiment that we're in. So this algorithm, this component of the algorithm tells you when the market closes above 1953 in silver, it will negate this bearish sentiment, and it begins to enter into a neutral zone. And then the next price close above it or below it will activate the next signal. Above it is a buy, below it is another bearish or sell signal. But it's a metrics that we use. Now, the weekly momentum indicator is the price momentum, basically, that we use, which is the same numbers basically above that you see here, price momentum 1897. This is the price momentum indicator. It's the mean or the average price pivot point for the week, okay? And so coming into this week, this told with the market closing on Friday at 1886 that this indicator by the price closing or going through 1897, it would mean that it's bullish because it will penetrate the average price, which is 1897, and it will close above 1897. It would close above the mean. That close would negate any bearishness previous to that by trading under that specific number of 1897. So what I'm showing you is how one triggers another. This is a constant algorithm that tells you when the price triggers the signals. and a way for you to identify when the momentum or the sentiment of the market is changing, so you can position yourself accordingly. Not only this gives you a specific price, but it tells you, the other side as well. And it tells you right here, it's below, it's bearish, but if we close above, it would negate that bearishness. Okay, so it's very clearly stipulated right here. Now, depending on what happens to the price, and this is what I teach you here, and I teach you individually on your individual coaching, how the methodology applies to these numbers that are static. And what essentially you got to take into consideration is the price movement into these numbers. With the silver market this week, as we came into this week, going through 1897, it reversed, it negated the bearishness, and essentially kicked in a buy signal from 1896 or below. The low was 1871 on the 16th. The 19th, the low was 1884. So it came right below the mean of 1897. It closed above it, which basically indicated the market sentiment is turning bullish. It begins to tell you when the market is changing, even before the price confirmation comes in. And what we have found in using this methodology, that the price basically is a consequence of this energy that we're analyzing prospectively. So we're preparing you and telling you, as we came into this week, by the market closing at 1886, it's a little bit bearish, but if we go through 1897, that bearishness will be negated. Closing above it would activate a buy signal. The target, 1923 to 1961. And the high that we saw yesterday was 1938. The high so far this morning is 1936. So as you can see here, we are stabbing into the weekly targets in the early part of the week, and the daily targets that we have now in the red zone or the supply zone are 1950 to 1971. So what you see here between the daily prices that are showing on the chart and the weekly prices that you see on the report, they're beginning to trade in that cluster of 3 to 1971, which is the resistance level that we have now identified in the market, right? 1961 is identifying the weekly resistance at the sell 2, and 1971 is the daily resistance. Just below that is the 1950 resistance. So now we begin to see a cluster building up of supply at these levels. And what we want to see is the demand energy, the price with enough strength to essentially take out all that supply that we're looking at in this vicinity, close above it, and then we're looking at pretty much targeting the previous high, which is 2052, 2025 actually, in that vicinity, and once that is taken out, 2122 comes into place. To look at the numbers a little longer, you can refer to the monthly report, basically, and in using the spreadsheet here on the right, the monthly report is telling us for silver 1971 to 2007. And that's what you call harmonic convergence, harmonic timing. Okay, so we have defined for you the supply area that seems to be building up. It's with a price, with very specific price, confirmation of the trend, the momentum, the price momentum, the trend momentum, and exactly what the targets are. And I'm teaching you the trigger points, and obviously, and how I'm using this to manage my portfolio by using the reversion to the mean. I buy the blue, which is the extreme below the mean. The green is the mean, and I sell at the extreme above the mean. Let's continue to watch this markets here and validate for us basically what the algorithm is indicating for us, what we should be looking for. If you have any questions at all about the work that I do, this is just a very basic idea of how I coach and how I teach in the live trading room by using live market and live trading signals. And if you would like to receive more information, please feel free to contact me, 805 area code 418-1744, or email me at support@ematotrade.com. Any comments or commentaries are very much appreciated. Once again, this is Patrick MontesDeOca. Until next time, my friends, be well, be safe. Take care.